The broadcast is now starting. All attendees are in listen-only mode.
Good morning and happy Monday. I want to thank everyone for attending this webinar this morning. My name is Tony Butler. I'm the Life Sales Director here. And today's webinar, we're going to be talking about One America and their product that they have available. We get a lot of questions in regards to life and long-term care as kind of a combo, or I should say requests that having life policies with long-term care attached to it. And One America is definitely one of the better options available out there. So we'll be discussing that. Roger Cantu will be going over their One America product. But prior to that, just wanted to go over some housekeeping items here real quick. So first off, here at Insurance Agency Marketing Services, we know that referrals are a major part of your business, and they're a major part of our business as well. So what we like to do is provide you with the bonus for any agents that you do refer to IAMS and they get contracted with one of the carriers that we work with. We do provide you with a $50 referral bonus. Any subsequent business that they submit with those carriers that they are appointed with, we do provide you with 20 basis points on that business. So it's definitely a good way to earn some additional cash. And for us, it's just a thank you for providing that referral to us. If you have any questions in regards to our referral bonus or our referred producer program, please feel free to give me a call. I'll be happy to share additional information with you, send out additional information. Next, for new producers, if you are appointed with insurance agency marketing within the first 180 days of getting appointed, we do provide what we call a new producers builders to help you grow your production. So we've got three different levels that are available. So we have the 100,000, 300,000, and 500,000 dollar level, and those are paid premiums. So within that 180 days, if you get $100,000 paid premium, we do have a $750 cash bonus that's available for you, or you can select the 2-year producer website or the iPad. If you want to bypass the $100,000 level and you think that you can hit the $300,000 in paid premium, we do offer either a Social Security program and a 3,000 piece mailing, or you can get $2,000 in marketing dollar reimbursement, or you can get a $1,500 Visa gift card. Now, if you think that you can hit that $5,000 level and you want to bypass the 100 and the 300,000, what's available for you on that level would be either a 5,000 piece mailing and seminar coaching with Matt Gill, who is one of our top producers, or you can get a 4,000 piece mailing and seminar coaching with Dave Pimper, who is also one of our top producers. If you just want to reward yourself for all the business that you have submitted, take a little time off, you can select the Ritz-Carlton travel package. Again, if you have any questions regarding our new producer builders, please feel free to give me a call. Next, I'd like to talk to you about our back office support. I think our back office support is second to none. We try to help you work smarter, not harder. So what we provide here at Insurance Agency Marketing Services is business building tools and resources. We do help you with case designs, both on the life and annuity side of things. We recently added Medicare supplement to our portfolio of products that's being offered. We do provide you with forms. They're at your fingertips on our website. We like to say that we support you from submission to commission. That's hard to say on a Monday. We also provide you with the ability to do life and annuity quotes. We can assist you with that as well. We have top sales expertise and coaching and paperless contracting. The two things that I want to point out in regards to our back office support, paperless contracting is huge If you've ever gotten contracted with the carrier, you know there's a lot of paperwork to be filled out. Once you have been appointed with one of the carriers that we work with, we can set you up on paperless contracting. So any additional carriers that you would like to get appointed with, um, at your request, we can submit that appointment. It helps you stay away from the painstaking task of filling out additional paperwork. We can take care of that for you. Life and annuity quotes, I want to touch on that here in a second as well. I think I have some valuable information for you regarding that. Creative marketing solutions. We have a creative marketing team that's comprised of Jacob, Tedlock, Sean, and Aaron. And they do an excellent job with helping you um, provide turnkey solutions for you, I should say, agency solutions, as well as digital solutions. What that means is our creative team can help you with handouts, flyers, help you with designing newsletters, postcards. What they can also do is help you with your branding. So if you were thinking about a logo design or looking to redesign your logo, they can help with that. They can help with business cards, brochures, stationery, advertising. And speaking in regards to the advertising, if you're looking to get in the digital marketing arena, they can help you with a personal website, digital marketing strategies, social media consulting, um, email marketing consulting, online newsletters, things of that nature. So if you have any questions or you were interested in doing something like this and needed some assistance in regards to that, feel free to give us a call. Again, ask for our creative marketing team. Jacob, Sean, and Aaron would be more than happy to assist you with that. We also have a 24/7 website here at IAMS, and our website has a plethora of tools available to you to help you help your clients with their needs. We do have excellent sales tools. We have a term quoter that's available on our website. That term quoter will allow you to run term quotes yourself. It will also allow you to do uh, guaranteed universal life quotes as well, and you can run comparative with all the carriers that we work with. We're in the process of adding index universal life to that, so you can run comparisons on that. If you have questions regarding the term quoter, please feel free to give me a call. I'd be more than happy to walk you through the process of doing that. The website is always accessible. As I stated before, we do have forms online that's available for you. We do have industry links available, current annuity news for those of you agents that are annuity agents or write annuity business. We do have an annuity grid. We also have a comparison of single premium life that's available on the website, a long-term care product grid. One of the things that I'm finding a lot of agents um, like to do is email quote request. Our website does have a link that you can click on that allows you to put in the client's information and send that quote request over to us. It goes to our life email address, and we can get that quote out to you in a timely fashion. I mention that because a lot of times when we do get an email for quotes, there's information that's missing, whether it be a client state or resident state, I should say, which is extremely important because that depends on type of products that are available in that state, um, product type, things like that. If you go online to submit that, that allows you to get all the information that we need to get that quote out to you timely. Also, if you happen to send an email to me and I happen to be out of the office, this is a good way to ensure that someone in the life department gets your request and get that illustration or quote out to you in a timely fashion. So if you have questions in regards to how to submit that online, please feel free to give me a call. I can show you where that is and walk you through that process. Next, we have an IAMS wealth management team. The wealth management team is comprised of Mike Hanson, Joe Wallace, and Charles Herring Jr. Our wealth management team can help you as an agent increase your revenue, improve client retention, and strengthen client relationships. The wealth management team has been in existence, I want to say, about 2.5 years now. So if there's an interest there for you in regards to how you can increase your revenue, how you can improve your client retention, and strengthen your relationship with your clients, please feel free to give our wealth management team a call. Joan, Mike, or Charles Jr. would be more than happy to answer any questions you have, send out additional information to you. We also have the Life and Annuity Academy. Now, if you're familiar with IAMS, you know that we do Life and Annuity Academy. We try to do that once a quarter, if at all possible. We do have one that's coming up here September 18th through the 20th, so that's like next week. With that, that particular academy is closed. We've already closed down registrations for that. However, we will be doing another one here in a few months. Just to kind of tell you about the Life and Annuity Academy, it's a 2-day training. Kind of break it down. The 2-day training consists of sales ideas and strategies from our top 4 producers. We talk about indexed annuities, annuity industry trends. I know the big thing with annuities, a lot of carriers you're seeing rates going down. So that is discussed along with strategies as far as writing additional annuity business. We talk about large life case marketing, case designs. So basically what this academy does, this allows us to share with you some sales ideas and concepts to help you as the agent grow your business. It is something that we pay for, so we pay for your travel, we pay for your lodging and your meals. Again, it's a 2-day training. It has a lot of helpful information available to you. So if you have any questions or if you are interested in the academy, I will send you some information here. I've got a polling question here for you. Just one moment. So if you would like information on that. So I'll leave this open. Okay, I'll leave this open just for a few more seconds.
Tony, I hear there's a little bit of silence. This is Roger Cantu. I just wanted to let you know I was on the call. I got done a little bit early.
Sure, no worries. No worries. I've got a polling question out here. I'm going to go ahead and close that out. So those of you that wanted additional information, I will get that information out to you. And Roger, you've got impeccable timing because we were just finishing up here. So with that, I have Roger Cantu, who is going to now talk about One America. So Roger, let me get the presenter changed over to you.
Mm-hmm. Awesome.
And there you go.
Let me make sure I have the right. Oh, no, that's not the right screen. Let me change the screen to this guy. See if that makes for a better. There it is.
Okay.
Good. 4 approaches, 4 different approaches there.
Yep. So I will let you take it away.
Tony, thank you. And again, I want to just quickly introduce myself. My name is Roger Cantu. I'm the RVP for One America. I work with the team Tony and the team there to help you do a better job with offering your client solutions that make sense in addressing, well, one of the most woefully under-addressed part of the retirement planning world, and I would say insurance world, and that is in the area of long-term care planning. And we have, and I've dedicated, not only have we been in the market for 30 years, but I've dedicated my entire career to asset-based approaches for long-term care, providing, of course, long-term care, but also a death benefit if never needed for care, and a sense of ownership in that cash value. The challenge is, and Tony and I talked about this leading up to the session, is that there's a lot of noise out there, a lot of confusion about the various approaches that are there in the insurance world for addressing long-term care. And I'd like to take this session to not only cover that, but also the importance of where we fit into the marketplace, meaning how One America is unique in the marketplace, and then to share with you an example of how that asset-based approach might work. So let's kind of look at this in three parts as we complete this hour-long session. So roughly, we'll call it 45 minutes. Now, the first area is to dissect or delineate, if you will, the insurance approaches that are out there for addressing long-term care. And the first, in my opinion, order of importance, is an asset-based long-term care plan. This is, if you follow the tax codes, a 7702B policy. And it is one that has the additional benefit of up to lifetime coverage, or what we call a continuation of benefits rider. Now, not a lot of contracts in this same 7702B world fit that additional requirement of having lifetime coverage. So a second tier would be life insurance policies with just long-term care riders. This is different than a chronic illness rider. This still is that 7702B chassis, right? Which means it walks and talks and smells like long-term care, but it doesn't provide that catastrophic protection with that rider. And that's what, the asset-based, meaning it protects your entire assets that exist in your portfolio. Now, number three would be that chronic illness rider. Different tax code here. It's not a 7702B policy that, triggers based on the loss of 2 of 6 activities. Rather, it is often hinged on permanent confinement. So we're going to explore that and its limited coverage nature. Finally, and I do see it as number 4, sadly, and that is traditional long-term care insurance, the use it or lose it model. And we'll explore these on a sort of a Ben Franklin, positive pros and cons of each and how many boxes we can check. So let's start with this asset-based approach, again, where I've built most of my, if not all of my career really, at this point, 29 years. And the asset-based long-term care plan is this 7702B policy that is filed as life insurance, but with long-term care access, meaning it accelerates for the purposes of long-term care, and that acceleration takes place, right, due to the same triggers as long-term care insurance: loss of 2 of 6 activities of daily living or care received as a result of cognitive impairment, right? And that, if I stopped right there, really applies to the next plan that we're going to talk about. Where we're different, what we'll explore here in a little bit, is adding to that a benefit that goes up to lifetime coverage. Now, there are other unique aspects of it as well: the joint coverage, the multiple funding options, an annuity solution, not just life. But what we're talking about here is addressing a complete loss due to long-term care. No matter how long you're in a facility. So that COB, or in this case, continuation of benefits rider, is available. It extends the coverage of the, if the death benefit is depleted to 0 for long-term care indefinitely. So the asset-based long-term care approach really provides guaranteed premiums, tax-free death benefits, tax-free long-term care benefits, guaranteed cash value, long-term care benefits known at the time the policy is issued. And that's going to be important when we look at those chronic illness riders. Benefits available for temporary conditions, not permanent confinement. And it can be, all of our brochures refer to as long-term care. They don't dance around it. A 101G policy must dance. because they cannot call it long-term care insurance. They have to call it, well, a chronic illness rider or an extension benefit or extended health care benefit. That, again, that's the dancing aspect. And then the benefit type can be either reimbursement or indemnity. Our plans are reimbursement. We feel strongly about that, and we'll be sure to get you a piece that kind of, again, delineates the difference between those two. So what makes asset care or our life-based option unique? I'm going to cover that in detail in the third part of this session, but just to, in a very general sense, it is the asset-based long-term care solution can cover 2 lives with 1 policy and offer those individuals lifetime benefits for long-term care. Further, we provide multiple premium sources as funding options. They can be a single premium of cash and an ongoing annual premium. That's about where the competition or alternative solutions that exist out there would end. We allow for 1035 exchange of annuities, qualified funding, the use of qualified funds. We have lump sum options for the rider as well as an annual pay. And folks, I mean, we have an ongoing premium as well. It's not like a 10 pay where the premium would be too stout for most clients. We can stretch that premium out over years and allow them a more reasonable premium. And then finally, much like one other carrier, we have been a leader for nearly 3 decades now offering these asset-based solutions. Now, there are other forms that are out there. In this case, the 7702B model has that same life chassis, right? But the benefits are not lifetime, right? They do extend the benefits, but for limited coverages. No other contract on a hybrid-based or asset-based chassis provides that unlimited protection. So kind of comparing the two, although they provide the guaranteed premiums, right? The long-term care premiums aren't necessarily guaranteed. That's the, aspect of the small print on the illustration. So definitely check that out. They do have a tax-free death benefit, tax-free long-term care benefit. Depending on whether it's whole life or the UL chassis, it could have a guaranteed cash value, but it may not, right? The benefits are known when you issue the policy, so there's no guesswork there. And then, temporary conditions certainly covers that. Again, 7702B, 101G policies, that's the one that may require permanent confinement. They do not have that continuation of benefits rider for the unlimited coverage. And again, it can be reimbursement or indemnity. So this is the one that's closest to our approach. The challenge is it enough coverage? Do we really know what the length of stay will be? Averages have been thrown out all the time. The challenge is the average Alzheimer's stay, which is an ever increasing condition and disease with longer and longer periods of time. The average stay for Alzheimer's is right now 8 years. Most of these other policies out there without lifetime coverage will fall well short of that average Alzheimer's stay. So let's look at the life insurance with chronic illness rider. So the first thing here is the tax designation, 101G. So that means that it is not necessarily based on a loss of 2 of 6 activities of daily living or cognitive impairment, right? Like long-term care insurance. These contracts, 101G, do have some more stringent requirements, and they're the policy that has to, if you will, dance a little bit around the whole long-term care aspect, meaning they cannot call themselves long-term care coverage. It's generally some other name like chronic illness rider. So you do have the ability to extend the benefit, right? But generally it's very, very limited. Your extension here is the ability to draw down on the death benefit, and in this particular case, it only lasts for 4 years. The other challenge with this approach is that, I'm a big believer in you cannot serve 2 masters. I'm sure you've heard that before. Well, if you're selling a life policy with the intention of its death benefit providing loved ones something, the grandkids getting through medical school or paying off the mortgage for the spouse, but yet you use it up for long-term care, or in this case, the chronic illness, then the death benefit won't be there. So, it's either or. With our approach, we only are selling it based on its long-term care benefit. The death benefit aspect is secondary. It's a byproduct of not needing it for long-term care. So how might this stack up? Well, first of all, it does have the guaranteed premiums, and it does have the tax-free death benefit, but it may not be entirely tax-free. With the 101G policy, once it goes beyond the daily per diem, which is pretty high right now, it's $364 a day in benefits, anything beyond that paid out would be taxable, right, according to the IRS. So that's one distinction with the chronic illness rider. It doesn't generally have a guaranteed cash value. It can or cannot have that chronic illness policy added onto it, but it certainly can't be referred to as long-term care insurance, and it generally is only for a permanent confinement situation. So that benefit's available for temporary conditions sometimes, but very often it's not. And then finally, that 101G policy pushes pretty heavily its indemnity nature, but the reality is the reimbursement makes sense in many cases, and it's very, very often makes sense to the clients in maintaining that benefit. So the key points here to remember with the chronic illness rider that are out there that you may have to compete with, number one is, again, it can't be referred to as long-term care. There is actuarial discounting very often that may end up requiring a lump sum payout for long-term care. Can you imagine how much that might go beyond the per diem, right? And that would then be taxable, right? So actuarial discounting is really being unsure what that benefit may be down the road. Temporary versus permanent condition, of course, the asset-based or 7702B approach is payable for a temporary condition as opposed to requiring permanent. And then the tax treatment, right, the 7702B, our approach, another couple of carriers out there, the benefits, regardless of per diem, are tax-free, where it may not be the case with the chronic illness rider. And of course, there are limitations of indemnity payments versus the reimbursement. I'll be sure to get that in your hands as well. Last thing I'll leave you with before we sort of move on to the last of these four is that, because it's not legally be allowed to be referred to as long-term care, I've seen every one of these is a real example from another carrier, an accelerated access solution, extend care, enhanced health care benefit, premier living benefits rider. I mean, it's suggesting it, but when you see that kind of language, be cautious, be very cautious. And then that, of course, that temporary condition likely may not be covered with it. It may be required that the individual, have permanent confinement in order for it to pay. So the last area that I do want to cover is, of course, the traditional long-term care. Now, I know some of you on the call may be thinking, geez, why dredge up a dead horse? But the reality is there is still a place for this contract. First, to admit, it has deteriorated down to a handful of carriers that are out there. But let's face it, folks, there are individuals out there who must have long-term care coverage, even if it's not, a lifetime coverage benefit, even if it doesn't have a death benefit. If it's a matter of economics, right, they just can't afford to do an asset-based approach, then this is the route that they need to head, because you do need this coverage. The challenge is it's slapped with that stigma of use it or lose it, right? Because there is no death benefit, there is no cash value. And the challenge further is they don't guarantee the premiums. So rather than a life policy, this is really health insurance designed to pay out for that loss of 2 of 6 activities. And you do have an extension of benefits, 4 or 5, maybe 6 years, but not the lifetime coverage. The other piece of it is there's a potential for future rate increases, and as we've seen, tougher underwriting standards with that approach. So how might it stack up with the other carriers? Well, the premiums are not guaranteed. The benefits are not necessarily tax-free. The chronic illness benefit of what they call the long-term care benefit, yes, is tax-free, but there is no death benefit with this approach. So there is nothing to make tax-free, right? There's no cash value on that approach. There is, yes, no question, long-term care benefits, because that's all it provides. And then it does provide for temporary conditions, loss of 2 of 6, like a broken hip, right? They may recover from that, and certainly can be called long-term care insurance. This is what we think of as long-term care. The challenge is it doesn't have that extension of benefits, can't do it jointly, and don't have multiple funding options. I do still see them as both reimbursement and indemnity plans. So the conclusion here is they're really not all the same. There is traditional long-term care, the life insurance with chronic illness rider, the 7702B policy without the extension rider, and then what we refer to, our solutions as an asset-based approach that really covers the gamut of those solutions. So the next area, and I'm doing a pretty good job here, Tony, it's about 15 minutes in, 10, 15 minutes to cover that first area. Let's cover the next one in that this then takes the asset-based approach that we just, compared and contrasted with the other carriers or other types that are out there. And let's highlight where One America is unique with these asset-based approaches. And as we see it, there are 5 key advantages to our what we call the care solutions, and that's asset care and annuity care. Again, we're covering only asset care, but I'm going to touch on our annuity-based solution here in this segment. We have catastrophic or lifetime coverage. I really flog that in the first part of the session, and I do for a reason. We buy insurance for that catastrophic or full loss coverage, and we'll talk about that and what traditional long-term care insurance carriers have been experiencing when it comes to claims. We do offer that joint coverage. We have a patent on that, so buying individual contracts always leads to more money going in the contract versus our economy of scale by having a husband and wife on the same plan. Next is qualified funding. No other carrier out there has an easy way of you using your clients' qualified funds to fund an asset-based approach. We do. I had mentioned we have the life-based, this is the focus of our session, but the annuity-based is equally important, right? So because it does provide more simplified underwriting, advanced stages, and the ability to do that 1035 exchange. Lastly, we do have 30 years of experience in offering the plan. So there's quite a few Johnny-come-latelys that are out there, and I'll mention a few of them here at close of this segment. But, you gotta know that they haven't had the experience underwriting claims that we have had. So therefore, if you see robust benefits or robust pricing, right, that for a plan that's only had a few years on the market, your knee-jerk should be to question that. All right, where is that premium? How can they do a better job versus the 2 carriers that have been out there for 3 decades? Let's talk about catastrophic coverage. Why do we buy insurance to begin with, right? I mean, what's the idea behind it? What's the fundamental of it? It is not for a small issue. We don't have car insurance to replace our windshield. We have it for, God forbid, a complete loss to that vehicle and the liability associated with it, having that coverage, right? So we can be indemnified against both replacing the vehicle ourselves or worse, having to deal with a lawsuit against us, right? So that's why we have it. We don't have it for that short event. We don't have it to, fix the tile in the bathroom when the toilet flooded or to replace the roof. We have the insurance for a total loss of that home, and we're willing to pay the premiums to do it. That should be the case for long-term care as well. We don't buy the coverage for that 6-month or even a 6-year stay, which most carriers stop at. We're trying to address the more pressing, more severe cognitive impairment or chronic condition. This is related to Alzheimer's, but it could be Parkinson's as well, right? And I know out there in the marketplace, you're hearing about the average long-term care stay. Well, if my feet were in a bucket of ice water and my hair was on fire, folks, on average, I should be feeling good, right? Based on that kind of logic. I mean, it's taking the best of the worst and the worst of the best and jamming them together and presenting it to you as an average. So here's these data points really mean nothing, but I'm sure you've all seen a scattergram like this where these are all the data points. Well, right there's the average. Right? That doesn't tell you a lot. There's not a lot of those dots that are touching that average. Many below, many above, and it's that extreme situation that we're really trying to address for our clients. So this comes right from our American Association of Long-Term Care Insurance website. So really, you could get this data for yourself, and the link is down below, and I'll be sure to send that to Tony to forward to everyone on the call. These are the top 7 carriers and the maximum length of stay and dollar amounts for their claims, meaning what's the longest claim and what have they paid out in claims for that. Now, a lot of policies were sold with lifetime coverage, but they dropped it. Our plan is structured where we can do that with guaranteed premiums. So let's take a look at it. And very often it's thought that it's the female. In the first example, it is. So company number 1 had $2.3 million expense over 16 years for her claim. But the second company is 19 years for a male, 2.2 million. Again, a little over 2 million, 16 years. Company number 4 there had 1.7 for the male, 1.4, and these are well north of 10-year stays. These company number 6, they're virtually tied, right, at 15 years each at 1.5 million, and then the female comes back for 18 years with company number 7. Is that a big deal? I mean, you have to ask yourself, even if 15 to 20% of my clients end up having a stay beyond 6 years, which is roughly the case, you know, which of my clients am I going to have to explain that their benefits ran out? Which one do I want to do that for, right? When in fact, you could address all of these areas. And these are the areas, same website, American Association of Long-Term Care Insurance. And these are the things that can happen that would end a long-term care claim. Well, sort of makes sense. We have recovery, right? They get better. That was obviously not a permanent confinement situation. So 14% were temporary, so that, you know, chronic illness rider wouldn't have even paid for. Obviously, a big chunk of that 72% is that the individual passed away. And then this is interesting, 13.5%, nearly as many that recover exhaust their benefits, right? So the benefits just stop. You know, 3, 4, 5 year stay, and it just ended, right? Now, another question you have to ask yourself, if the clients knew that the benefit was limited, you know, from the get-go, how you know, how many of those pushed out filing the claim to begin with to stretch the benefit? Maybe they had a, you know, someone in the family care for that loved one in the initial part of the claim. So something to consider if you have a long-term care solution with death benefits, cash values, guaranteed premiums, and lifetime coverage, pick a scenario, and that policy would end up, you know, checking the box, which of course we do. Now, why the joint coverage? Why is there an advantage, one of those 5 keys, compared to the others that are out there? I'll just try to highlight that based on other hybrid-based solutions that are out there. So we have a joint, meaning a husband and wife, they're early 60s, right? And this is comparing a joint $150,000 asset care policy to the other carriers that must split up the couple into 2 plans. So, you know, all's fair in love and war, they take the 150 and split it in half, 75,000 each, because again, they don't have the joint coverage as an option. We have a patent on that. So the 75,000 in those 2 individual policies not only provide a lesser benefit than the asset care plan written jointly, so it's across the board less than what we can provide by making it joint, but their benefits run out in 6 years, where that higher benefit and both covered would pay out for the balance of their lives. So whenever you have a joint situation, if you're not coming to Tony and his team and asking for One America quote on a joint basis, you may be doing your clients a disservice. You very well may. So let's talk about qualified funds. So this is area number 3 of uniqueness, and this is really very unique because if you have qualified funds and your clients would prefer to use that to address their long-term care, build their plan for long-term care, the competition would tell you, well, you've got to cash that money in, pay the taxes, and whatever's left, not only are we going to, you know, have you pay taxes on it, but we're going to split it up into 2 policies. You really don't want to do that. But a lot of folks, both advisors and clients, don't know that you can use qualified monies. Well, is that a big deal to use qualified funds? I would say so. At $2 trillion of total assets of retirement annuities that are out there. I mean, versus variable annuity sales, fixed annuity sales. I mean, you know, a smattering compared to the qualified funding that is out there. Another statistics related to the annuity-based solution is that when it comes to qualified funding, you're not writing a check generally for those dollars. So in this case, clients are more apt to, as you know, fill out transfer paperwork as opposed to writing a check for their CD dollars. So giving them the option of utilizing qualified funds, a more prominent part generally of their portfolio, and having them do transfer paperwork versus writing a check is going to grease the rails for the sale when you go to close that. So let's move on to the annuity-based solution. And this, I know, Tony, is we weren't going to cover in depth, and I promise it's only going to be touched on, but I have to bring this up because almost half of the decline, same website, American Association of Long-Term Care Insurance, almost half of the applicants that are declined for long-term care insurance fall in that age range. So from 70 to 79, we have 44% of individuals or declines happen in that band. Well, the average age that we're writing our annuity-based solution is 74, about the middle of that. And with its easier underwriting, right, and the ability to do a 1035 exchange into it, it all adds up to an opportunity. What does the opportunity look like? Well, this is a Gallup poll from 2009. 83% of non-qualified annuity owners say they intend to use their annuity to avoid being a burden on their children, a financial burden on their children. 73% specifically said it's for a long-term care event. So they're owning these non-qualified annuities. They're ready to be taxed, right, if they need it for long-term care. We can reposition that in an annuity-based solution, liberate it of income taxes altogether, and have it pay out for long-term care, and even have that extended rider. Lastly, I'd mention those other carriers, so let's bring them back to the fold and when they entered the market. And you got to ask yourself, is it about track record, or is it about really being the most attractive? And the challenge is that if you quote these, even on an individual basis, where we don't compete as strongly, right, as the joint, where we almost always dominate, the individual contracts for the other carriers are, several of them promising the world. I mean, there's an awful lot of great features to the plan, and the benefits might surpass ours, but yet they've been on the market for, really only the last 6 years. I'm talking about the last 3 there. There's only 2 carriers out there, ourselves and the company on a penny, right at the top there, that have a 30-year track record. So just when you're going about quoting these plans, think hard and long about whether or not it makes the most sense for the client long term to be with a carrier who's had that kind of track record. I'm going to defer on the Q&A until the end, Tony. This is moving into that third segment, and that is an overview of the asset-based approach that is, well, really the most popular of our approaches. Not the only solution. I mean, represents maybe 20-25% of our overall plans, and realize too that it can be also funded to expand that with qualified funds or annual pay or even the annuity solution. But this will give you a good grounding of where now the One America plan, in this case asset care, the life-based approach, is unique in the marketplace in sort of like a true life example. So again, just to recap, we have a life insurance-based solution, or what we call asset-based long-term care, and the product here specifically is asset care. The annuity-based solution, real clever marketing people, they put it right in the name there, annuity care. And we have that plan, the sets of solutions or chassis broken down based on the various markets that exist. So with asset care, this is a whole life insurance plan with long-term care benefits, a 7702B approach that can be either a single premium plan with or without a return of premium. So they could use cash, CDs, money markets, they could 1035 exchange an old life policy into it. And you can build it where it maximizes the long-term care benefit or it maximizes the liquidity, and that would be with the ROP, or return of premium there. Next is the use of qualified funds or the 1035 exchange of non-qualified annuity. Yes, those can go into a life-based approach. Now there's the middleman there of, in this case, a little bit of taxation, but it's spread out over 10 years, and it provides a way for you to take, let's say, the husband's IRA and cover a plan member jointly on both he and his wife using his qualified funds. So that annuity funding whole life can be a huge advantage when it comes to finding unique ways to fund the solution. And lastly is that recurring premium plan. So the life-based option, not on a lump sum, but ongoing premiums. So that would be cash from income. It could be required minimum distributions they're already making on their qualified funds, meaning they've attained age 70 and a half. It could be pension retirees. It could be folks that have the single premium but are unwilling to unload it, right? So they keep it, quote unquote, invested, and then have the investment yields off of that go into our plan. So they're dollar cost averaging out of their portfolio and into protection. And again, our focus here is on the asset care, the life base. So suffice to say, there's different markets for our annuity based solution as well. So do look for that. When I send you the marketing information for it, I will make sure that I send you the links to register for either. So here's the concept of self-funding. Very simply, it's like, you're either by choice or default deciding to pay for long-term care expenses yourself. Well, let's just, first of all, what are the odds of that happening? Well, they're, surprisingly high. It's about 68.9% of folks over age 65 require some form of long-term care. So roughly 2 out of 3, right, will need some form of long-term care. Without a plan, this might as well be a dartboard, because there's a bullseye somewhere on this 70% of the time for long-term care expenses. So where does it come from when they need that care? Well, they're going to, start drawing, in this case, $75,000 a year. In some parts of the country where you are, maybe more, might be less, but it's a good number to work off of. $75,000 a year after year after year after year after year, and it could gobble up that entire portfolio, or make it so difficult for the healthy spouse to live out their retirement years that it's irresponsible. I'm just going to say it. I have 4 children. I don't want them getting into my finances, nor do I want them to have to take care of me, right? They may have all the love in their heart to do it. I hope I've earned it. But the reality is, it shouldn't be their job. They have their own life to live. That's hard enough, right? So by having a long-term care insurance policy, which I do with my wife, in place for lifetime coverage, we're the only carrier out there that does that, and to cover this adequately enough so it does not force the children to have to come in and be that care provider. I'd rather them supervise the care performed by someone skilled to do that, and they can continue to live their lives. So what we're saying is, with this asset-based approach is, again, take 2 of those years, right? In this case, less than the average long-term care stay, and certainly about 25% of the average Alzheimer's stay, 2 years, and reposition 2 years worth of that portfolio, or in this case, $150,000 to $75,000 expense years for long-term care, and do that. Be proactive. Do that upfront, and reposition. Could be qualified funds, but in this case, I'm using a CD. And for that early 60s couple, that CD would leverage up in death benefit. Remember, this is an asset-based long-term care plan. Well, that 150 represents the cash value. There's fees coming out of that to provide the life insurance, but that life insurance lever up from 150 to 200,000. Of course, on joint policy, it would be second to die. That then becomes their long-term care benefit. So they're levering 150 in their CD up immediately to 200. Well, that in and of its, and if care's never needed, the 200 would pass to the heirs tax-free. So, could make a strong case for just doing the base policy. But, of course, that's not what happens. Tony knows this, that the real benefit of the solution is the ability to add that rider for up to lifetime coverage, thus insulating the better part of your portfolio on an unlimited basis, right? Lifetime coverage, to allow your healthy spouse to continue to enjoy their retirement or have that inheritance go on to your heirs, because you know long-term care is going to be addressed indefinitely. So here's an example of that. Remember I said early 60s? Well, the male is age 60 at the top, female age 59. They're both non-tobacco, relatively healthy, right? And they've already passed it buying a long-term care insurance policy, right? They're looking at, $4,500 a year, and they can't guarantee the premiums, right? If they end up never needing it, mind you, they're 60. So let's say they live to age, 85. Well, that's 25 years at $4,500 a year. And oh, by the way, it's not even guaranteeing it's that, because that 4,500 could escalate to 6,000 and 8,000 in that 25-year time frame. But they, again, pay into it. That's well north of $150,000 that would then end up just going away if they died and never needed care. Again, 30% of the time that will happen, 70% they'll need the care. But in this case, having that death benefit and cash value provides that easy answer to the objection. So with our couple, they're going to put in this case, $156,000 from their CD. And based on their ages, right, just roughly, that will create a death benefit of $200,000. So this is your first line of defense in the case of long-term care. So how it would pay out, maybe several ways to do that, is a 3% draw of the death benefit. So again, Tony could craft the illustration really the best way that he knows how, but when you come to him with the client, it may be 2, 3, or 4% of the death benefit per month that you could draw. And again, that's going to be based on age and health and what makes the most sense for the client. Well, we can do the math on that. 3% of 200,000 is what? That's $6,000 a month, or roughly $72,000 a year. And that payout for just one of our two couples. So let's say she ends up needing care before him, right? Well, if it were the other way, the wife might try to take care of the husband, but no offense, not a sexist statement, but there's a maternal instinct that if the husband needed care, she would try to, that maternal instinct would kick in and care for the husband. We don't have that as readily, right? The maternal instinct. So if the wife needed care, this could pay out 2%, or in this case, 3% of the death benefit, $6,000 per month to cover that care. And if, again, just she needed it, it would last for 33 months, right? I haven't even got to the rider yet, but let's just focus on the death benefit. So you're looking at that going, all right, well, the wife's got a benefit of $72,000 a year, but it's going to, be less than a 3-year, which is often perceived as that average long-term care stay. Well, we could exhaust that death benefit, and then she would run out of benefit, and the husband wouldn't have any benefit, right? And there's no death benefit paid out, right? Well, it's not about the death benefit. Really, it's about the second piece. It's about being able to cover both of them on an unlimited basis. But it's paying out that death benefit first, meaning have an acceleration of the death benefit for either husband or wife, or both, and have that exhaust so that that rider would then kick in. So this is going to be a separate premium for them. Let's bring this laser in here so you can see it a little bit better. This is going to be a separate premium, either an annual premium, or you could divert some of the single premium over to buy this rider. And it could be a doubler, right? So if this pays out for 33 months, you could add a rider for 33 more months if you wish. But many, when they see the premium for that, it's very reasonable, and a guaranteed premium for that lifetime protection, they opt for it. So what is this? But shelling out that additional premium, what would it provide? It would provide that same $6,000 a month for both for the rest of their lives, no matter how long of a stay they end up having. And you could see some of those stays were quite long. Now, I want to stress something here. I started with just focusing on the life because if, God forbid, husband and wife needed care at the same time, mind you, that's a per person or per insured benefit. So really, again, this is where they have a traffic mishap, let's say, they don't perish, but both now need rehabilitative care for the rest of their life. They would each have 3%, or $6,000 each. So So really, if that were the scenario, mind you, they're going to have this rider for lifetime coverage. We're focused here, and 3%, 6,000 or each, or 12,000 per month, you're going to consume that death benefit in just over 16 months, 16 and a half months. That death benefit would be exhausted. That's all the more reason why that lifetime coverage, covering both of them, is so very vital, right? Again, that would pay out 6,000 a month each, burn through that death benefit, one or both, kick in the rider, and continue to pay out ad infinitum, which of course is Latin for forever. Now, again, let's say they never need care, right? They both pass away. 200,000 goes there. So they've committed $156 and maybe $3,600 a year for that rider, but yet you have a death benefit of 200,000 if it's never needed. Again, there's that built-in measure of protection against that and providing that full coverage for that exposure in long-term care, especially for a chronic condition. So we have, this is just a way of illustrating those payout rates. If you have a $200,000 death benefit here, 2% of which would be, what, 2% of 200,000 is 4,000 a month. So you can get a lesser benefit and have that payout for a longer duration, right? And that would give you the option for the rider of another 50 months or lifetime coverage. You can even build inflation into either of those. So what I showed you was a 33-month. I showed it to you because that's the most popular of those payout rates. So 3% of the same 200,000, now you have a 6,000 rather than a $4,000 a month benefit that would exhaust, again, in 33 months for one, if it's a joint policy and both needed, 16 and a half months. Then you have a doubler, right, rider, it's gonna be less cost, of course, or lifetime, which, price difference isn't so much that the doubler is more popular. Lifetime is definitely more popular. Now, on a single life case only, it's not joint life, you got a couple of unique options here. Number one, first of all, on a single, you can do a 4% draw. You got a $200,000 death benefit, and you got a 4% draw of 200. Now that's 8,000 a month, isn't it? But then you're going to use that death benefit up in 25 months. Your options are threefold. You have the doubler, right, just like the others, and lifetime. But you have a sort of a middle rung here, middle way, right? So you have a 25 plus 25, meaning a total of 50, 25 plus 50, or a total of 75 months, right? Or again, 25 and lifetime. So here for single life, they get 8,000 a month in my example for the rest of their lives if they bought that lifetime rider. So to really get moving with this for you, hopefully you've thought of some clients, couples, primarily that could benefit from this. You're really going to be, or Tony's going to ask you for roughly three things. One, how they plan to protect it, fund the protection. So it may be annual, maybe single premium, maybe the use of qualified funds, but hopefully you have some idea which direction to head with it. And if not, I mean, you could run all three if you wanted to, but options creates confusion sometimes. So narrowing that focus. And a key question to ask, by the way, is if you or your spouse were to need long-term care, God forbid, which of your assets would you liquidate first? Right? If your spouse were to need long-term care, which of your assets would you liquidate first? Not how are you going to pay for it. That's a totally different question, and usually wrought with a totally different answer. You want them to realize that if they don't do something, they're going to be risking everything, right? What is the age of the clients? And I'd add to that smoker. So how do they want to fund it? What are their ages, and do they, again, this is smoking, it could be cigars, it could be, pipe, it could be vaping even, right? Although there are more liberal rules with marijuana in states that have it legal. And then lastly is just some sense of their health, right? A good question to ask in the last 10 years, have you had a significant health issue in the last 10 years? And you might know that if you've sold life to them. Here are some conditions where with the asset care plan, generally 50% of asset care would accept this condition. Now it may end up being rated, right? But the asset-based or the life-based option, especially on a joint basis, could potentially accept bipolar or diabetes type 1 and 2, a kidney transplant. It could even take care of somebody who after a stroke or a TIA just 6 months afterward could allow them coverage on a rated basis. And then again, with all of these conditions, 100% of annuity care cases it's not required that they have an APS or a paramed exam. So all those conditions also could be acceptable on the annuity care, again, depending on the severity and any other related conditions. What I'm getting at is on the annuity-based chassis, you do have more liberal underwriting. However, the benefits are generally far superior on the life-based option. Just to kind of give you a sense of the underwriting, these are the height and weight charts. These are usually pretty mind-boggling for a lot of folks. I'm 6'2", and got on the scale today is a little over 200 pounds. So really you could add, what is that, 130 pounds, and I could still do express underwriting, which is just a short phone interview. You could add 162 pounds to me, and I'd have to order my medical records, but I mean, my gosh, that's almost another human being added to me, right? So very liberal height and weight chart. So again, let's just do a recap of this, and then we'll answer any questions that you may have, of course, through my co-host, Tony Butler. Is doing a great job, I'm sure, up to this point. So let's go through those differences. We have both a life and annuity-based solution, giving you a pivot point from the underwriting that may be more challenging for some of your folks. Next, we do a joint policy versus only single lives, or splitting husband and wife into two different plans. We can do it jointly. We have a variety of funding options. Let's go quickly through them. Single pay with ROP, ongoing annual premium up to, not only a 5-pay, but on ongoing pay. Use of qualified funds. You can roll that money over without taxes. Same thing with a 1035 of a life or an annuity chassis. So again, variety of options. We have that optional lifetime coverage where others do not. We have a claims concierge service that's been out there for about 10 years. They do an excellent job in processing the claim on your behalf. And then we have, of course, very reasonable underwriting. I do want to bring to your attention the plans that we review at Asset Care, all of these plans and annuity care, I cover each week on 2 training webinars. You're going to see links at the bottom of the email that I'm going to work through Tony to get in your hands. These will get you through the deep dive of asset care or the annuity care, and I even have a short session that I do, and you could be a guest of IAMS to go through a more advanced training on that. So I went about a couple minutes over, Tony, but those were the 3 areas that I wanted to cover. And with your help, I'm happy to answer any questions that your folks may have.
Okay, thanks. Roger, you can hear me okay, right?
I can, yes.
Okay, cool. Here's what I'm going to do. I'm going to change the presenter back over to me. Okay, can you see that?
I sure can.
Okay, so I'm going to open it up for a couple of questions. If you have a question, please type that in and we'll try to get that answered for you. Okay, I've got one. What is a 101G policy?
Great. Again, they're really 2 stylings. It's a 7702B policy. And really the big distinction there with a 7702B is that it has the same triggers and ability to perform 2 of 6 activities of daily living or cognitive impairment. So it triggers just like a long-term care insurance policy would, right? Which means it'll cover for a temporary condition. A 101G policy has a different distinction altogether. Number one is you're not required to pay out for temporary care, meaning if you break your hip, you have rehabilitative care, but you're likely to recover from that. The policy might not pay, likely won't pay. Meaning,
you there?
Permanent in nature. Sorry, Tony, go ahead.
Okay. All right, and then I've got one more. Are there RMDs sent by One America from Asset Care?
Well, the distribution coming from an asset care plan, meaning when you move money over and we make a distribution on that every year, we're going to send a 1099, of course, to the IRS. But what I'm saying is that distribution every year for 10 years, whatever that amount is, counts toward required minimum distributions. I hope that was your question. Now, where you also may be going is if they have an IRA currently and they're making required minimum distributions because they've already attained age 70 and a half, what I was saying there is they could simply, if they don't need that to live on, they could divert that to our annual pay policy. So that's where they would send us that benefit. It would still count toward RMDs, but now you're converting that to long-term care protection.
Okay. All right, I'm not seeing any other questions. So what I'm going to do real quick, I know, Roger, that you said that we get out some additional information, but do have a polling question. First one is, if you'd like to get more information on what was discussed today, I'm launching that here real quick. Just go ahead and vote on that and make sure to get that out to you. I'll leave this open for a few more seconds.
And Tony, I'm just going to send that to you. That'll include the pieces I referenced in the session, and the website that I referenced in the session,
Okay.
and then, information about the deep dive training.
All right, sounds good. All right, and I'm going to close this out. And lastly, if you're not appointed with One American and you would like to get appointed, got this polling question for you as well, and I'll make sure to get that appointment information out to you. I'll leave this open a little bit longer. A few seconds more as people are still voting. Okay, we'll close that down. And again, I'd like to thank all the agents that attended the webinar. I think this is some very valuable information, Roger, that we needed to get out to our agents to kind of clarify, life insurance with long-term care attached to it. So any closing remarks that you have, Roger, at all?
Well, other than, as I said up front, this is the most woefully unaddressed part of a retirement plan. And in my opinion, the biggest unaddressed risk for individuals. So in the insurance world, that's our job. And I'm asking you to explore the options that exist out there and bring this to your attention to your clients. You'd be surprised at how open they will be when you have something to talk about other than expressly needing it for long-term care, death benefits, cash values, and so forth. So Tony, and I'm sure the team there will help you do that, and I'm happy to help as well.
Awesome. Thank you so much. Again, everybody, thank you for joining us this Monday morning. As always, greatly appreciate you attending these webinars. I find this extremely beneficial to you as the agent. So again, if you have any questions at all, please feel free to give me a call. And with that, I'll go ahead and close down the webinar. Roger, thanks again.
You're welcome. So
everybody, have a great week. Bye.